Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of April 28th. Thank you for joining us. Don't forget to like and subscribe to the video and the channel if you find this information helpful. Also, take a minute and check out some of the other great content that we put up. So with that said, my goal for these videos is always to use my background in economics to help you better understand the markets and the economy so you can make informed financial decisions. So with that said, let's get ready to hit the books and get up to speed on the markets. So as usual, let's get started with a quick look at last week. Last week, one of the big headlines was the Consumer Sentiment Report for April. We had actually seen the preliminary report 2 weeks ago. We knew the report wasn't going to be great, but there was a little bit of positive information coming out of this report. Specifically, the final results for consumer sentiment ended up being better than the preliminary results. In large part, most analysts suspect that the reason for this slight improvement is the fact that the preliminary report captured the initial April Liberation Day tariffs, but did not capture the 90-day pause. The final data for the month of April actually captured the positive impact that the 90-day pause has had on both consumer and investment sentiment. Despite the slight improvement from preliminary to final results, April was still not a great report. April was the fourth consecutive monthly decline in consumer attitudes. We also saw that the future expectations index dropped by the largest amount since the 1990s recession. We also saw that consumers have continued to become more pessimistic about both personal finances and their income in the future, with continuing concerns about both inflation and unemployment. The monthly consumer sentiment report focuses a lot of time and effort on inflation and future personal finances. Unfortunately, the inflation report for April actually reached its highest short-term 12-month expectation since 1981. 12-month or next year inflation rates increased from 5% to about 6.5%, while long-run inflation expectations increased from 4.1 to 4.4%. A lot of the change in the long-run expectations were actually driven by a shift in attitude among independent, politically affiliated survey respondents. Taking a quick look at housing, we saw existing home sales decrease by about 6%, which was the steepest decline since 2022, while at the same time, we saw new home sales increase by about 7%. A lot of the decline in existing home sales seems to be related to affordability concerns as well as high interest rates, with the median existing home price still above $400,000. Also last week, we saw the monthly update on durable goods. We saw new orders for durable goods, meaning goods that last for an extended period of time, increase by about 9%. A lot of that was driven by airline and transportation manufacturing, and some analysts demonstrated some concern that this is most likely pre-buying and pre-ordering in response to potential tariffs, and will most likely result in a significant decline in the future as that pre-buying essentially just pushed up the timetable and didn't actually increase the total amount of purchasing. The Conference Board last week also released their Leading Economic Indicators Index. And unfortunately, the Leading Indicators Index dropped by about 0.7%. And the majority of that drop was driven by three specific areas. The first was a fall in consumer expectations. The second was falling stock prices. And the third was a significant decrease in new manufacturing orders. Last week, as far as the jobs market, we saw the number of initial claims increase slightly, while we saw the number of continuing claims decrease by about 37,000. Relative to the 1.8 million continuing claims, it's a relatively small move, but it's definitely an important trend to watch, as we've seen ongoing stagnation in the labor market. We also saw S&P Global publish their U.S. flash results for overall economic activity. The U.S. Economic Activity Index dropped to a 16-month low, while unfortunately the prices charged rose at the highest rate in the last 13 months. Unfortunately, there continues to be concern about inflation, potential unemployment, and the potential for a future economic slowdown. And as the data unfolds, we'll continue to bring those updates here. Shifting our focus to the Q1 2025 earnings reports, some of the big headliners, starting with Tesla. Tesla saw a 71% drop in net income and missed on just about every financial metric of substance. But at the same time, in their earnings reports, CEO Elon Musk mentioned the fact that he intends to shift his focus away from the Department of Government Efficiency and back towards Tesla, which acted as a healthy reassurance to the markets, and we actually saw shares in Tesla gain throughout the week. Alphabet, parent company of Google, also announced fantastic financial results, beating on both earnings and revenue. They announced that they'll be increasing their dividend by 5%, and they're planning a $70 billion stock buyback in the near future, which resulted in investors responding extremely positively and pushing the share price up throughout the week. A significant number of consumer-facing companies in their earnings reports mentioned the ongoing concern about tariffs, and in response to that, some major consumer-facing firms, including Procter & Gamble, PepsiCo, and United Airlines, either reduced their forward guidance for 2025 or completely pulled and eliminated their forward guidance, specifically citing uncertainty around tariffs. We also saw telecom giants Verizon, AT&T, and T-Mobile, all three mention in their earnings reports that they plan to pass on any additional tariff costs directly to their customers. Switching our focus over to the stock market, it was actually a pretty good week for the market across all three indices. Although it was a pretty choppy start, we saw significant gains throughout the week in both the S&P 500 and the NASDAQ. The Dow Jones Industrial Average had a relatively mixed week, but ended the week up by about 2%. Ultimately, the week started with a lot of concern and pessimism surrounding the trade wars and the ongoing conflicts. But what we saw develop early in the week and carry us through the rest of the week was significant reassurance from both the Trump administration and President Trump himself, indicating that there is a desire to reduce tariffs and to reduce trade tensions, specifically with China, and ongoing reassurances that the president has no intention of firing Federal Reserve Chair Jerome Powell. These reassurances seem to be exactly what the markets needed to take on a slightly more risk-on posture for the week. Taking a quick look at the 10-year Treasury, we saw the yields on the 10-year Treasury move only slightly up and down throughout the week, ultimately ending the week only slightly below where it was previously at a level of about 4.27%. In the risk-on environment for the week, throughout the week, we saw the price of Bitcoin increase dramatically. Bitcoin actually increased more than 10% by the end of the week, finishing the week around approximately $95,000 a coin. Moving over to some of the alternative investments, we saw the price of crude oil rise early in the week and then fall a little bit later in the week. We saw the value of the dollar, the US dollar, recover only slightly from some of its previous lows. And we saw the price of gold hit both a record high on Tuesday of approximately $3,500 an ounce and a one-week low towards the end of the week, slightly above $3,300. Well, that about wraps up last week. So let's switch our focus over to this week and what we see coming in the future. So this week, we continue with Q1 2025 earnings season. Almost 180 of the S&P 500 companies will be reporting this week. We'll see some of the Mag 7 players come out this week, including Meta, Microsoft, Amazon, and Apple. We'll also see a few other giant American companies reporting their earnings for the first quarter, including Chevron, ExxonMobil, Visa, MasterCard, and Live Nation Entertainment. Also, in this week's earning reports, we'll hear from real estate giants Welltower and American Tower, consumer giants Coca-Cola and McDonald's, materials giants Linde and Sherwin-Williams, and the single largest healthcare company by index weight in the S&P 500, Eli Lilly. In addition to a huge amount of earnings reports being released this week, we'll also see a massive amount of economic data. So specifically, early in the week, we'll see the latest update on consumer confidence following a couple of pretty rough declines in the consumer confidence space. The question is, how big or how broad will the confidence decline be in April? In addition, we'll also see the Personal Consumption Expenditures Price Index, or the PCE inflation data for the month of March. Ultimately, we saw a weaker than expected CPI report. So the big question on everyone's mind is, will the PCE follow suit, or will we start to see some reflection of the increased tariffs that began in February and March? In addition to the inflation data, we'll actually finish the Econ-Trifecta this week with the initial estimate for Q1 GDP, gross domestic product, and the labor reports for unemployment for the month of April. Specifically, with regards to GDP, the Federal Reserve Bank of Atlanta's nowcast estimation tool is currently estimating a negative 2.5% GDP contraction, which would suggest that the economy not only slowed, but actually shrank in the first quarter. And with the ADP unemployment reports, as well as the national unemployment report, the last 2 months have shown slight increases in the level of unemployment. So the big question in the labor market is, will we continue to see a worsening set of conditions for workers and those that are unemployed? In addition to all the other economic data I've mentioned, on top of inflation, unemployment, and GDP, we'll also see monthly economic reports this week on factory output, construction spending, wholesale and retail inventories, manufacturing reports from ISM, new and pending home sales. We'll see data on home prices from the Case-Shiller Home Price Index. And finally, we'll see the trade balance for the month of March. So I know this probably sounds like an incredibly overwhelming amount of information coming out this week. And in most circumstances, it would be. But fortunately, you've chosen to join us here on the Market Update, and this is actually what we do best. We're going to sift through and read all the reports, look through all the data, and we're going to bring you in a concise and easy to understand format the most important information so you can make informed decisions. Looking to the future, the big question is whether we'll start to see signs of an economic slowdown or a resurgence of inflation, or the economic impact on the ground of the tariffs that have been implemented in the last 60 days. Now, of course, we continue to watch the trade negotiations. We're about 1 month in to our 3-month pause on the major Liberation Day tariffs. So the big question continues to be, what are we going to see in the hard economic data? Will we see trade agreements negotiated before the end of the 90-day pause? And can we start to get a more certain, more clear picture of what the future of our economy looks like? With that in mind, we do our best work in this kind of environment. When there's tons of information, more than any one person can take in by themselves, that's where we shine. So we'll continue to read through the data and bring you the most important information and help keep you up to speed on the markets. Thank you again for joining us. Have a great week, and we'll see you again next week.